Hello everyone, I'm David Boal and I'm a partner in the Investor Relations team at Coller Capital. I'm pleased to be joined by two of my partners, Bosa Adeghe, who heads the team pricing secondary transactions, and David Jolly, who works with UK pension funds and other institutions who are looking to sell private market positions. We'll be sharing an update on the private equity secondary market and the LP-led sales process. Specifically, we're going to cover the current market for LP-led opportunities. Then secondly, what's driving pension funds to sell in the current market. And thirdly, we're going to outline the steps in the LP-led sales process. So, Bosa and David, thank you for joining us today. David, could I start with you and just ask what happened in 2022? The year seemed to be, at the start, a continuation of the hot market of 2021. But then the world changed. So what happened, particularly in the second half of the year?
Yeah, I think you're absolutely right, David. 2021, as you mentioned, was a hot market, the largest year for secondaries, a market volume in the 130 billion, 140 billion range. And that came through into 2022. The start of the year was very busy. Q1, a lot of transactions being done, being closed. But then we had the conflict in Europe, the inflation story coming to prominence, the rising interest rates, and generally more uncertainty across the board. So that really saw a slowdown in the market in Q2 and Q3. Having said that, 2022 was still overall a big year for secondaries. We think the volume was in the $100 to $110 billion range. And in the period post-summer, we were seeing transactions coming forward, transactions closing, and a lot of that was LP-led portfolio sales. And so in 2022, that part of the market itself was still over $50 billion. So I think showing the resilience of that part of the market in a time of more macro uncertainty was very reassuring and positive.
So given that we had this quite lively market in the second half of 2022, that must have affected pricing. So Bosa, perhaps you could talk a bit about what you saw in terms of price movements, and indeed whether there was any differential movement between different asset classes, or indeed amongst different vintages in the private equity buyout market.
Absolutely. In the course of 2022, a portfolio of decent, good quality buyout interest could generally get sold at a low single-digit discount to NAV. We often saw portfolios get sold at NAV or even premiums to NAV for very high quality portfolios or very young vintage portfolios. In the course of 2022, there was a market change. That same portfolio of buyout interest would generally be sold at something in the order of a 10 to 15% discount to NAV. And I'd say that for a very large portfolio, that discount was realized through the use of mosaics as well, with multiple buyers fitting together to deliver that price, as opposed to a single buyer in market being willing to underwrite in large size. So a meaningful change on the buyout side. As it relates to credit and infrastructure, pricing held up better given the low risk profile of those strategies. And often transactions could be done in the order of a 10% discount or maybe a high single-digit discount to NAV. As it relates to growth and venture, discounts were much larger, often being in the 30s or the 40s, given that technology had been a sector that had been impacted the most as it relates to the public markets. So all in all, the lower pricing as compared to 2021 was a function of just a different risk environment. It was harder for buyers to forecast the future cash flows that their portfolios or potential portfolios would deliver. And there's just more uncertainty around what valuations actually should be, given that there had been limited movement in private marks relative to public marks. Put it all together, even with that movement in pricing, it was still a very busy year, to David's point. And it's also worth noting that none of these transactions, for the most part, were driven by financial distress. These transactions were completed by parties who are taking a long-term view of their allocation to private assets. And these are parties that are looking back at the strong performance of their portfolios over time. So with that context, a 10 to 15% discount to NAV, it could be a very rational price on which to move forward. And there's also real opportunity cost to not doing something. Every dollar that remains invested in private assets as opposed to something else has an opportunity cost. And so for many parties, it was worthwhile to move forward with the transaction on the basis of their long-term plans.
So Bosa, that's very interesting, that picture of a market which is unlocking and where there's price movement and volume rising in the second half of the year. Many finance directors of a defined benefit pension scheme which their company is sponsoring are reluctant to recognize a discount. So did you see a tendency amongst some sellers to prefer the credit and infrastructure where there was a shallower discount than, say, venture or buyouts where the discounts were deeper?
That dynamic definitely came into play. We saw many portfolios that were brought to market which on day one included a range of strategies, from credit to infrastructure to buyouts to growth to venture. And in many of those situations, the portfolio that ultimately transacted included perhaps credit, infra, and buyout. Now, ultimately, buyout is the largest component of the secondary market. And in order to realize a target level of liquidity, there's generally a need to include some of that within a sale portfolio. But it's definitely true that the optics of the discount on credit and infra were favorable. So those were seen as less of an issue than growth and venture on the other end of the spectrum.
Okay, so comparing this market in 2022 to the market around the time of the great financial crash in 2008, the discounts notionally applying in 2008 were much deeper, but I'm getting the feeling that the volumes were really quite sparse then, and that we saw a lot more volume in the second half of 2022. So David, if that's the case, has the market cleared? Was it just a flash in the pan, or can we expect further motivated selling in 2023?
So I think, David, we expect to see further motivated LP-led selling in 2023. The factors that we talked about driving the market in the latter part of 2022 are definitely still there and still prevalent. Those factors of over-allocation to private markets, also the theme of distributions drying up to some extent from private equity portfolios, those portfolios not being self-funding and LPs maybe looking for some liquidity against them. LPs looking to reshape their portfolios to keep supporting their preferred GPs and so on. Lots of themes coming out of the market movements in 2022, but a lot of LPs feeling those effects decided to stay on the sidelines and still have yet to come to market. But as Bosa said, there is still the uncertainty around how do the current conditions impact portfolio company earnings, what does it mean for exit horizons, etc. So we're almost seeing a stability in pricing. So I think that gives the LPs who have been on the sidelines, who are now receiving their Q4 NAVs, they're seeing pricing in the market being quite predictable. I think that is giving them the confidence to come forward. So we actually see quite a busy market in 2023, particularly for LP-led portfolio sales.
Okay, so the picture I'm getting is that it's not a market crisis which drove this change in secondaries pricing and volume in the second half of 22. It's more to do with the relative valuation of public and private markets, so that some people find they're now over-allocated. And as you say, perhaps distributions are not going to be as good as they were, and therefore there's some motivation to sell. Bosa, maybe I could ask you, because you're the man who actually gets to price these fund books when they come, Which sort of institutions are you finding are the sellers? We know that perhaps the LDI crisis in the UK has changed the attitude of some UK institutions, but is this a phenomenon which is wider than that?
I think absolutely. Some of the points that David mentioned as relates to over-allocation to private equity, slowdown in distribution pace, and also kind of looking ahead to future commitments to new funds that are in market, are relevant to a full range of asset holders. So you think of that as being financial institutions, corporate and public pension plans, endowments, family offices. All of these institutions face the same challenges to be open. So in the course of 2022, all of those seller types were represented in the market. And we expect much the same for 2023. To your point, UK pension schemes have certainly had a greater need to think about liquidity needs in connection with the LDI issues faced in the second half of last year. But for the most part, many of those parties were already thinking about their private equity exposure and paths to reducing their level of risk. So to a degree, it's bringing forward plans that were and discussions that were already being had. An interesting factor as it relates to 2022 is that 50% of sellers in the market were first-time sellers, which goes to the point about increasing awareness of the secondaries market as a path to addressing long-term portfolio allocation decisions. And it bodes very well for the future in that any party that uses the secondary market and has a good experience in doing so is very likely to come back and use it again to solve either near-term issues or longer-range issues. So a very broad range of sellers, both last year and expected again this year.
Okay. Two very interesting points there, Bosa. Firstly, that you foresee that it's a natural tendency for defined benefit pension schemes, perhaps, to begin to liquidate private markets holdings as they move towards their end game and have their liabilities bought out. But this other fact that 50% of the sellers last year were first-time sellers, I think is quite significant. And David, if I could turn to you for a moment. When people are approaching this process for the first-time sellers, what are the main steps they need to prepare for in liquidating a fund book?
Yeah, happy to run through that, David. And I think initially, a lot of that is thinking and work on the LP side. I think it's very important for an LP to know what do they want to achieve from a potential sale process. Is it they have a need for a certain dollar volume of liquidity? Is it they want to exit certain GP names that they may not be re-upping with? Do they have certain and specific price targets in mind? So there's a range of things for the LP to think about that determine their objectives. And I think that's important, that the LP know what they want to achieve from the transaction. And going through that process, they will be evaluating their own portfolio, identifying a portfolio potentially for sale, deciding do they want to work with an advisor or do they want to run it in-house, and gathering the information that they will need to make available to the potential buyer. So that process is largely on the LP side. How long that takes can be really determined by the LP themselves and their own processes. But they get to a point of launching the transaction. And that is when they approach potential buyers, go through the NDA process and make initial information available to the potential buyers in a data room. And they will be specifying a timeline, looking for bids. And I think there's a question that the LPs need to think about there. Are they going for a one-round process, or are they expecting a first round of indicative bids and then a later round of binding bids? But let's say you go through that process to maybe a first round of bids and then a second round. That could be a question of a couple of weeks of the first round, a little bit of time to clarify those bids, select bidders to give a binding bid, and you could be looking at another couple of weeks. So it's not a long process once you get to that point of pressing the button and getting the bids identifying your buyer. You then need to go through the process of agreeing documentation for the transaction, notifying GPs, beginning to work through the transfer process. That again need not be a long process, particularly on the documentation side, but it can take a little bit longer because you do need to work with the GPs to actually transfer the positions. But overall, particularly if there is intent on both sides, it's very possible to get from pressing the button on your transaction to closing and receiving cash within 3 months. And if speed, liquidity, the pace is one of the key drivers of the transaction, certainly Bosa and I and the team at Collar have worked directly with sellers to do that process a lot quicker, more like 4 weeks start to finish, where that has really been one of the key objectives of the seller.
So this is not just a matter of pricing then. There's a great deal of documentation, and the execution of the transaction really can be fairly complex. You want, as the seller, to be able to rely on an efficient execution to achieve your objectives. Bosa, quite often people say to me, why don't I just get the broker to go around the market and get me the best price for the assets that I want to sell? You have found, I think, that that is not a common approach at all, and that a lot of sellers want to work directly with you as the man who prices the book and with us as a firm to ensure the execution. Would you like to talk a bit about your experience in that sense?
Sure. I think brokers play a really valuable role in many transactions, but to your point, we have many precedents of working directly with holders of assets to find a solution. That's ultimately what we're trying to do. An example would be a financial institution that we worked with in the course of 2022. And this institution had a desire to sell down exposure before year end in order to crystallize certain gains that have been generated over time. To the earlier point made around pricing in this market, even though that party was willing to transact at the discounts that were prevalent in the course of 2022, that still resulted in them crystallizing a meaningful gain given the strong performance of private assets over the preceding years. In any case, our relationship with that party allowed us to observe and take a look at the broader portfolio that they owned, which comprised a number of venture, growth, and credit positions. We worked with that party to say, if we were a seller, this is the portfolio that we think is optimal in order to raise a target level of liquidity and to secure a target level of crystallized gains. We have a lot of off-the-shelf pricing in respect of funds that are regularly traded. And we also have a very strong sort of data science capability that allows us to supplement bottom-up work and basically put forward a view on a portfolio price in very short order. And given that we're working directly with this party, there wasn't a need in this instance for the regular way indicative bid stage, binding bid stage. We had a very good understanding of this seller's objectives, and therefore we were able to work from day one towards a specific date to deliver a bid that would be workable for their board. To the points that David mentioned around the logistical matters around transfers, such as getting underlying managers on board, thinking about a PSA, thinking about transfer agreements, these are all matters that we have a lot of experience with. So even though this was this was sort of a bilateral discussion, we were able to provide input on all of those matters in the same manner that brokers often do. So to your point, brokers play an important role in today's market, but where a seller values speed and values kind of achieving an objective without necessarily having their plans be visible to the broader market, this sort of bilateral discussion with a trusted party is very valuable. And as a result of that sort of discussion, there are many sellers that we have worked with on a repeat basis over more than a decade, because parties do see value in that sort of relationship.
Thank you. Thank you both. So, just to sum up, first is that secondaries pricing moved significantly in 2022, not because of financial distress, but because of changing liquidity appetite amongst investors. Secondly, it wasn't only or even mainly the LDI crisis which changed liquidity appetite, and the process of right-sizing private market allocations has not yet run its course. Third point is that the process of selling a portfolio is complex and normally takes weeks to months to complete. Brokers are playing a key role in the market, but given the importance of execution and the complexity of most portfolios, there are benefits to working with a buyer who has available capital, like Coller Capital. Bosa and David, thank you for providing those insights into what's happening in the secondary market for private assets. Especially for first-time sellers, it's a challenging market to navigate, but we've seen that working with a partner with the experience and resources to price and execute a secondary sale can provide the best outcome for the pension fund or other institution. And from all of us at Coller Capital, thank you for joining us today.